In this week's video, we'll review some of our longer-term charts to help us answer the question, is the market's risk-reward profile starting to shift?
To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player.
We'll kick off the video with a quick update to the analysis we performed in August of 2016. You may remember the signal had only occurred 10 other times in the last 35 years. Reviewing this signal will help us better understand the market's current risk-reward profile from a long-term perspective as of Friday, February 24th. You might remember the previous signals that occurred dating back to 1982. The market rallied on average after the signal for 108 weeks. The 11th signal or occurrence came back in 2016, and it was based on our, for illustrative purposes, only 30, 40, and 50-week moving averages in blue, red, and green. When we updated the analysis in October before the election, we still had a constructive look here from a long-term perspective, which turned out to be helpful. And we revisited it again in December of last year to help us discern between volatility to ignore and volatility to respect from a long-term perspective. So how do the same three moving averages look today? As of the close on Thursday, February 23rd, 2017, the S&P 500 using these three long-term moving averages has what we refer to as a full-bore bullish look, where blue, the fastest moving average, remains on top, and all of the moving averages have positive slopes, and in this case, price is above all of the moving averages. When we originally presented this analysis back in August of last year, the S&P 500 had just broken out of a long-term consolidation box, and heading into the U.S. election, it appeared that we had a false breakout. And as we know, stocks rallied, and in this case, another quote from Market Wizards applies. I find that major trends are now frequently preceded by a sharp price change in the opposite direction. Here's our sharp price change in the opposite direction prior to the U.S. election, and then we rally strongly, and the rally aligns with the long-term signal with the 30, 40, and 50-week moving averages. How does this help us today? It tells us from a long-term perspective, the bias is unequivocally up. How does the present day compare to a full-bore bearish look? February 23rd is on the right side of your screen. Blue is on top. All of the slopes are positive. That really doesn't look anything like the full-bore bearish look or the concerning look that we had early in calendar year 2008. We had a full-bore bearish look. Blue was on the bottom, and the slopes of all of the moving averages were negative. This low probability look here really doesn't look anything like the present day. Nor does the present day, using these three long-term moving averages, look anything like the low probability look late in calendar year 2000 in the early stages of the dot-com bear market. And our quote referring to major trends also dovetails nicely with last week's analysis. In each case, 1982 to 1985, we have a move in the opposite direction before the major trend. A move in the opposite direction, in this case, before the major trend. A move in the opposite direction, in this case, before the major trend. A move in the opposite direction before the major trend. Last week's analysis used daily moving averages, the generic and for illustrative purposes only 100-day in blue, 200-day in red, and the 300-day moving average in green. We use generic moving averages in these videos to illustrate basic concepts used by the model and basic concepts about trends. The model uses similar concepts, but it doesn't necessarily use these specific moving averages nor these time frames. In last week's analysis, we pretty much just covered bullish outcomes with the 100-day, 200-day, and 300-day. Good inputs and good signals should also help us with bearish outcomes. If we use the same 100, 200, and 300 day, we're looking at 1996 on the left side of your screen. The right side of your screen is 2009 and the end of the financial crisis. This is our constructive look here. In these periods here that weren't particularly favorable from a risk-reward perspective, we can see the moving averages look quite a bit different. We always talk about facts in hand and making decisions based on observable evidence. Here's a good example of that. We can see favorable odds here from a trend perspective. We can see the favorable and constructive look here. We can also see that during the earlier stages of these bear markets here and here, the observable evidence starts to shift. This looks different from this period here. Therefore, it can be helpful from a risk-reward perspective to look at these unfavorable periods and compare them to the present day. These are full-bore bearish looks, with blue the fastest moving average on the bottom, and the slopes of all three of the moving averages are negative. We can see in the early stages of the financial crisis, we shift over to a full-bore bearish look with blue the fastest moving average on the bottom, and the slopes of all three moving averages roll over. How do these unfavorable looks compare to the present day or February 2017? If we look at the exact same moving averages, February 22nd, 2017, you can see the present day really doesn't look anything like the two unfavorable periods on our screen. We can also learn something looking at the observable evidence and comparing the present day to these periods that had more favorable odds from a risk-reward perspective. And thankfully, in February of 2017, this chart looks a lot more like these favorable periods than the unfavorable periods. We still have a full-bore bullish look with blue the fastest moving average on top, and the slopes of all three moving averages remain favorable. If we switch back to our unconstructive look, we can see the present day really doesn't look anything like the early stages of the dot-com bear market. The present day really doesn't look anything like the early stages of the financial crisis. Is it possible that this chart here morphs into a look like this? We know the answer. It's absolutely, positively yes, but it hasn't happened yet, and we allocate based on the facts in hand. We don't use these moving averages to forecast. We use them to monitor and adjust if needed, rather than anticipate and hope. It's always important for us to understand that these are longer-term signals and these are longer-term trends, and pullbacks are inevitable. They are going to come at some point, and we don't forecast that either because it's very, very difficult to forecast. Remember last week we said the present day looked a lot like July of 1985, July of 1995, and October of 2012. And if you know your market history, you know that good things happened in all three cases. But when we examined the aggregate path for these cases looking forward 317 days, it helped us understand that the market's not going to necessarily make anything easy on any one. The aggregate or average path for these three instances here saw the S&P 500 gain roughly 20% over the next 317 calendar days. But to get from point A to point B, there's a lot of volatility and pullbacks here that you have to withstand. And the model helps us discern between that volatility to ignore within the context of an ongoing uptrend and volatility to respect when longer-term trends look like they're starting to roll over. If we understand what a normal pullback might look like in advance, it's easier to take it when it happens. Last week we said if we peaked the A to B fibs, we might see moves down to any one of these areas here. Since the stock market went up over the last 4 trading sessions, we would have to update this and make the B a little bit higher. But we can still use the same basic concepts that from the present day, we could see pullbacks to these 3 fibs here all the way to the 61.8% retracement And that still would look like a normal pullback within the context of an ongoing and existing bullish trend. So as we head into next week, not much has changed from a game plan perspective. We know that to get from point A to point B, pullbacks are going to come. But if we look at the trends and the observable evidence, it's easier to make decisions when we pull some of the day-to-day volatility out of the equation. The 1995 example, this is an extremely strong bullish trend, but if you just looked at this chart here, it really doesn't come across that way. But when we put in the 100, 200, and 300 for illustrative purposes only daily moving averages, it does look like a strong trend. We know good things happened after October 1st, 2012. It didn't mean it was easy, and it never is easy, and we don't expect it to be easy going forward. But this look here is definitely easier to make decisions relative to volatile price. Going forward, that flexible, unbiased, and open mind will help us remain open to all outcomes, including the worst bearish outcomes. But we know the look of this chart here mathematically will have to change if we're going to roll over into a multiple year and high magnitude loss bear market. And we can also say with a high degree of certainty, something that we can't say about the future, that the present day looks a lot more like these favorable periods than these unfavorable periods.
How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.